Jonathan Miller is the president and CEO of Miller Samuel, one of New York City's largest residential property appraisers and consultants. We welcome him to InsideTrack. Jonathan, thanks so much for coming in. So more rich people are renting versus buying. How is that? Because we assume if you're rich, you have tons of money, you can do what you want. Why wouldn't you want that tax write-off on the mortgage payments?
Well, I think it's sort of a temporary phenomenon. What we're seeing is sellers that are sort of disaffected from coming off of market peak, meaning they can't get what they want for their property, are deciding to rent them. So people that were on the fence about buying now have more options, and as a result, they're renting. Plus, they're nervous about the next couple of years.
So I guess they want to keep cash on hand, or maybe just put it to work in other areas besides tying it up in a mortgage.
Absolutely. I think it's a combination of having more selection in terms of rents are off a little bit and prices are up a little bit. So on top of that, they're really hedging for the future.
And I read through some of your research, and it seems like this is the first time that this has happened, this kind of phenomenon, since 2009. So not that long ago, but we did seem to take sort of more than a year break from people looking to rent. Is that right?
Yeah, it was really unexpected. We really, in the last 6 months or so, this phenomena has really taken hold. And in fact, in some very high-end projects, there's a waiting list to find units for
Yeah, you had some
people.
listings there of monthly rents more than $15,000 a month, right? Sort of these like penthouse, really.
Right, which represents the top 1% of the rental market here. And that market is very robust.
And in that group, that more than doubled to 77%, the people who want to rent in the third quarter. Is that right?
Yeah, essentially what you saw was a doubling of activity at that end of the market, which is very unusual.
It does sound unusual. Now, what is the middle share of the market? If that's the top 1%, what are the rest of the people doing? Sort of the upper middle class range, if you like. I don't know, maybe what does that account for in rent terms anyway?
Well, you're talking in the neighborhood of $3,000 to $5,000 a month. You have to remember that New York itself is a rental market. About 75% of the housing stock just in Manhattan alone is a rental market. So
what is this middle ground then doing? The $3,000 to $5,000 per month renters, how are they comparing in activity compared to that top 1% that's willing to pay $15,000 or more per month?
Well, it's actually very robust. There's been a lot of activity. In fact, what happened was, the end of last year, we saw a very little, landlords are offering concessions for people to renew their lease. This year, they're not offering concessions, so people decided to look for new digs.
Some of the concessions were pretty fun, weren't they?
2 to 3 months of free rent, which is substantial. So if you think about it, every month is an 8% discount. A year later, there's no concessions offered. That's a 24% rental increase. It forced people to go out and look at other units.
Now, Jonathan, I know you don't have a crystal ball, but here's the question, because we are going to start a new year.
Right.
What do you think? I mean, are these trends going to continue into the new year? I mean, what does it depend on?
Well, I think it depends a lot on the unemployment situation, which New York seems to be a little bit better than the national, but it's still very weak. And so I think you're looking at a moving sideways scenario on this phenomenon. I don't think we're going to see this accelerate. I think we're going to see more of it, however.
And I know, again, in your research, you sort of highlighted this idea of developers of unsold condos are also adding to the supply. So it seems like it's going to take, how many months to work through that supply?
Well, I think you're looking as much as 5 years to work through what we call shadow inventory, which is condominiums that have essentially not been able to be absorbed in the market since the fall of Lehman and the change of the credit situation.
So you basically still have not seen a bounce back since September 2008. I mean, from that part you can just mark on your calendar, you still haven't seen the market come back, even in New York.
I describe it as a rebound, but not a recovery. I still think we have a ways to go. Credit's still very tight, and unemployment's unacceptably high in terms of seeing the housing market improve.
And I guess arguably, even if people still have their own jobs, I mean, they read the papers, they listen to the news.
They're worried about job retention.
Yeah.
So there's a informed but conservative optimism, if that makes any sense. And in other words, people are exploring options. They want to be here in New York, but they're not quite ready to jump in and make a $40 million acquisition.
Right. Even the rich still want to hold on to a little cash. Thanks very much, Jonathan.